question here is, well, what's in the diversified portfolio that makes it work? You may have heard me talk about the 5 Bs of asset allocation. So when we look at assets, I refer to defensive and growth assets. So I like to think about things you can invest in as being in 5 categories, or the 5 Bs. So starting at the defensive scale, we have bills, which is cash, bonds, which are loans to governments and corporates, and bullion, which is still code for commodities, but for most practical purposes, that means gold. Then we move on to the growth assets, which is bricks and businesses. So bricks is infrastructure and real estate. Businesses are stocks and shares. So that's the 5 broad categories. But within each of those, there are nuances that can make a big difference. So you may have heard of a thing called the 5-factor model. Eugene, Fama and Ken French developed a 5-factor model, which there's 3 of them for shares, which is market. So generally the market, you get the market return. And in the context of investing, that means do I buy Australian shares or US shares or British shares or German shares? There's size. So generally, large companies underperform small companies. They may not for some time, but when you look at the returns, that's what the evidence shows. And then the 3rd factor for shares is what we call the growth of value index. So that is, are you buying companies that are highly priced relative to their profits because the market expects them to grow rapidly? So most of what you've been investing in the US, Apple, Google, Facebook, Amazon, Nvidia, they're all growth companies. That is, they trade on a very large multiple of their current year income with the expectation that that income is going to grow really quickly. So you're paying more for the same expected cash flows. Therefore, on average, you should earn less. There are a couple more that have developed over the years. We talk about quality, which is the Warren Buffett story, and momentum, which is a trading indicator. But the 3 big ones are market, size, value. Then we look at bonds. There are 2, which is duration. So what's the duration of a bond? Longer duration should give you a higher return. If you buy a 10-year bond, you should expect a higher return than a 5-year or a 3-year bond. And quality. So quality is what's the probability of you getting your money back. So a AAA rated issuer like Australia, for example, has a much lower probability of defaulting than Kazakhstan. And so you would expect to get a higher return for buying Kazakhstan bonds than Australian bonds. That applies equally so in the corporate space. So generally we talk about investment grade being BBB plus. So in Australia, that's Qantas at the bottom, and BHP, Rio, the banks at the top. So not only do you allocate among the 5, but you need to allocate among the factors as well. So most actively managed funds are actually factor funds in disguise. So Berkshire Hathaway is a value company. Warren Buffett's strategy is to buy value companies. Platinum was always a value company. So you need to look at the style of the manager, but generally you're paying actively managed prices for what amounts to factors. And they can be bought much more cheaply using algorithmically based funds. The ASX 200 is a value index. The S&P 500 is largely growth oriented. And that's why you see those differences in returns. Now, those factors work out over time, but they can be wrong for long periods of time. And value has underperformed despite what the models show over the past 5 years or so.